Hey everyone, and welcome back to another portfolio update for today. So over the past week, the cash investing portfolio took a hit. Yeah, a big hit, 6.3%, whereas the S&P was basically flat, was down 0.2%. Year to date, we are now down 3.92%, whereas the S&P is actually up 1.28%. There's some interesting data with regards to the market overall and who leads the market. And then since the start, the portfolio is still up around 142%, whereas the S&P is up 39%. And so in today's video, we're going to go over the upcoming earnings week because that's going to be a very, very interesting one. We have some market data to go over, not that much, but it does tell us what's going on with the market a little bit. And then I'll go over the companies, of course, that I've been adding to the portfolio, the company that will report next week, go over the earnings expectations and all of that. We'll end the video, as always, with a little bit of sports and entertainment. All right, let's start off with the earnings calendar. So on Monday before the open, we already have Pagaya. For me personally, they report. Then there is also Monday.com. Of course, when you're called Monday.com, you have to report on a Monday. Would have been strange if it was a Friday or so. After the close, we have here, what was that with my voice? After the close, we have Open Door. I think that's the only name, Amcor as well on Semi. So the top three here are the most popular names. I'll touch on Pagaya in a bit. Tuesday before the open, we have Coca-Cola, which reached all-time highs not that long ago. CVS Health, Spotify, Datadog, Fiserv, S&P Global, AstraZeneca, Ferrari, Oscar Health, and Marriott. For me personally, of course, Oscar Health is going to be the more important one. Tuesday after the close, we do have a new position of mine, which is Robinhood. We have Astera Labs, Lyft, Ford, Upstart, Cloudflare. That's for Tuesday. Then on Wednesday before the open, Shopify, Vertiv, Unity, Humana, Kraft Heinz, T-Mobile, McDonald's. I think Shopify, Unity are the more interesting one for us. Wednesday after the close, AppLovin has gotten quite a lot of attention more recently. Cisco, then maybe HubSpot, Fastly. I didn't know that still existed, but those are the names for Wednesday after the market closes. Thursday, a huge one for me before the open. That's, of course, Nebius. We did have Iran report this week. Next week, next Thursday, we do have Nebius. We'll go over the numbers in a bit. We also have Brookfield, Crocs, Zoetis, and then also Birkenstock. After the close on Thursday, Coinbase, Pinterest, Arista Networks, Rivian, JFrog, Toast. I think if Toast reports quite good figures, it should be a good indication for something like a Shift 4. We also have DraftKings, Applied Materials, Expedia, and Dutch Bros. Then as for Friday, it's not as interesting as the other Friday that we had with SoFi. Still Moderna and Wendy's report on that day. Now if we look at Robinhood for fiscal 25, which is the fiscal year that's behind us, company is expected to have grown around 53.4% and then to grow another 5% in fiscal 26, then another 14.9% in fiscal 27. Now, as you know, with Robinhood, since the peak here in October, which was the same peak for Bitcoin, it followed Bitcoin. So on Friday, when we finally had a green day in the market, Bitcoin was up, I think, 10-11%. Robinhood was also up 11 to 14, 14% or so. Currently, Bitcoin has continued to go up a little bit. As long as that's green, I think on Monday, Robinhood should also be green. Now, what we see here is, of course, Robinhood has had quite a big pullback from the peak, down 45%. At one point, it was down 50%. Market cap $65 billion. And then you see here the PE, trailing PE, 30.4 times. So you might say, wow, 30.4 times trailing PE for a company that's growing this fast. Seems strange, right? But then you also look at the forward PE and you look 55 times. Something doesn't make sense here. Well, exactamundo. If you take the past 4 quarters, which is what we still have right now, then you can see that there was that one quarter, which was 12 months ago, where they have that one-time benefit that made everything look much, much better on a trailing 12-month basis. But over the next couple of days, we're going to get this number right here, and you're going to see the trailing PE change. With Robinhood, there has been a lot of conversation around, oh, okay, crypto is down, market is down, so maybe they'll lose money. Well, they'll generate less money because of the volumes and things like that. But I think the market is still missing the big elephant in the room, which is the prediction markets. You know, Robinhood's supposed to be an investment platform, things like that. They are mixing investing with, in my opinion, gambling, right? Prediction this, prediction that. It is a gambling. It is a great business to have because it is a money-making business, but it has no business to be on an investing app. I still think they'll do well. Wouldn't be surprised if we're going back to $100. Then we have Pagaya, very small company market cap-wise. Pagaya is expected to grow revenue around 27.4% for the fiscal year that's behind us, and then see growth decelerate substantially from 27.4% all the way down to 15.4% for fiscal 26 and around 13.6% in fiscal 27. I would be very surprised if they do not grow faster than this. Pagaya is a company worth $1.56 billion, generating $1.25 billion, and a forward PE here right now sits at 8.1 times. The average analyst price target sits at $40, which is more than double where we're at right now. Like I said, I'd be very surprised if their growth figures aren't beating Wall Street's expectations. Luckily for us, we don't really have to wait that much longer to get the results. And then we have Nebius. Now, Nebius on Friday went up 16.6%. Friday was a very, very good day to end a horrible week. So we're back here at $86 per share, 18.6, close to $19 billion in a market cap. Now with Nebius, we know that when we look at revenue right now, it's very, very small compared to the market cap. But if you look at the targeted ARR for the company, well, and of course, assuming that they reach that number, I don't think we are expensive at all. This is what they told us 3 months ago. And of course, we're going to stream the earnings report and call on the stream with the usual guest for Nebius. Strong momentum into 2026, $6 to $9 billion expected annualized run rate revenue at year end 2026. So basically ending 2026 at a certain figure, you multiply that by 12. Yes, I know, it's a very strange way to say it. Then these are the numbers that we had 3 months ago. So we will have to go back and see if these numbers have changed. The current plan for contracted power at calendar year end 2026 is over 2.5 gigawatts. Maybe they've already updated us on this number, maybe not. I don't remember every number in my head, but we'll see on Thursday. Connected power for calendar year ending 2025 was supposed to be 220. For calendar year ending 2026, that's between 800 megawatts and a gigawatt. If it's more, amazing. Last quarter, they also told us that they sold out all available capacity. And then for 2026, I think they were on their way to be sold out. So would be great to hear that, okay, we are now already sold out for 2026. I think that would completely break the stock in a good way. Core AI infrastructure business, 19% adjusted EBITDA margin. Group revenue growth, I mean, huge growth on a small base here. So not that surprised. And of course, they did raise a significant amount of money. They also told us that they expect the core business to have turned EBITDA profitable in Q2, with the entire group, including all businesses, projected to be EBITDA break-even by the end of 2025. The company maintains a medium-term outlook for EBIT margins in the 20 to 30% range, driven by scale efficiencies, operating leverage from its large engineering team, proprietary infrastructure builds, and disciplined financial management, including a conservative 4-year depreciation standard for Hopper chips. Then let's have a look at the portfolio. So at one point, actually, Google was number one, but then I added a little bit more on SoFi, and SoFi on Friday did go back up. So that is now still number one. So you have SoFi, Google Alphabet, Nebius, Rocket Lab, AMD, cash position here. I'll explain how it went up. dLocal, Micron, Meta, Uber, Baba, Shift4, Rubrik, Oscar, Pagaya, Robinhood, Netflix, Duolingo, which is the worst position here, a couple of shares of Nvidia, and that one tracking share of Palantir. Now, what did I do over the past couple of days? Well, first of all, I sold a bit of iron, as I basically said last week. I sold 100 shares at the start of the week and 200 shares when I released this. Why? Not because I'm not bearish, but because I like Nebius more at the prices that were here February 6th, which of course was before everything went back up, but it doesn't really matter that much. So the money, the cash that was deposited here is basically from the sale of those 300 shares of iron, which will go into probably a bit more of Nebius, definitely more of SoFi after that amazing interview from Tanner and Tavis with Anthony Noto. I mean, the fact that he said that we're going to grow, 35% in Q1, and he would be disappointed if this is the fastest growing quarter of the year. Okay, didn't need to hear anything else. So yeah, even though SoFi is the number one position here, SoFi at around $20, I wouldn't mind adding more. Wouldn't even mind adding to a giant like Meta either, because Meta, if you look at how cheap it is, first of all, Meta is basically back to where it was before it reported amazing earnings, right? Literally went back here. We've seen it with Amazon, not the quarter that happened right now, but 3 months ago. Meta is a company with a trailing PE of 28.5 times and a forward PE of close to 23 times. Now, let me remind you something. Meta is a company that just generated $200 billion over the past year. And guess what? It's expected to grow around 24% this fiscal year. 24% growth when you're already generating $200 billion. I think it's worth paying 22 times earnings, don't you think? And then when you look at the 27 and 28 expectations from analysts, I think it's a bit laughable. I don't think we're going to see such a deceleration in growth in 27 and 28. But for 2026, you're growing just above 24% year over year on a $200 billion revenue base. Yeah, I think I'll pick up more shares. Then I increased my Nebius position by 5.45% at $78.31. Increased my Oscar position by 13.85%. Completely filled the last earnings gap up. I'm accumulating more shares at a lower price than my average, which helps, of course, drive my average down. 2026 is the year they get back to profitability unless that changes. I'll keep buying when the market offers opportunity. I think at the prices that we're at right now, which is $12.24 market cap wise, I mean, if they tell me that 2026 is still going to be the year where they are expecting to go back to profitability, then this is dirt cheap. If suddenly that guidance changes and 2027 guidance changes, right, the $2.25 of EPS, 5% operating margin or something like that, then okay, then maybe it won't be as cheap as we thought, but it's definitely not an expensive stock. We've seen Molina get hit 30% or so. Molina, the Michael Burry pick, down 30%. But as we've seen 3 months or so ago, Molina also reported before Oscar. Guess what? Oscar still reported an okay report because we already knew what was going to happen with profitability and medical loss ratios and things like that. But revenue for 2025 still expected to be quite good. For 26, we're expecting growth, but we're also expecting to see the company go back to profitability. If that happens, well, I think we're going back to $18. Continuing here, I added another 7.41% to my the local position at just under $13. Continue to increase my Robinhood position by 33.3%. It's a fresh position, so I think I will still have time to accumulate more shares at around $80 or so. Still increasing Meta. I bought 2 extra shares. That's a 7.1% increase at $680. And yes, I added more SoFi at $21.26. That's just a 3.42% increase. I did sell all my shares of PayPal. We'll touch on the options in a bit. At a 30% loss here. As I said in the video, don't have to explain myself here again. They lied or they didn't tell us the full story. That's unacceptable to me. I'll most likely sell my options as well and pivot to Robinhood. So far, I still have what's left of the options. And then this was already reported the last time we talked about the portfolio. And so you have here Robinhood at 1.73% of the portfolio. Robinhood and Netflix. I mean, it's funny because both of these stocks are trading at almost the same price. It's not the same market cap, but just the same price per share. And so now that I have a bit more cash, now that we've seen that stocks have come down substantially, I don't know if Friday was the bottom. We already did an episode on that. Could be the bottom, could not be the bottom, I don't know. But I already like the prices that I'm seeing for a lot of these names. Remember, the market as a whole can go down while your names, the names that you own, don't have to participate. They can actually go up. The market can go up. The stocks that we own might continue to go down. I think we're now entering, I've said it I think last week as well, a market where good companies get rewarded, bad companies get punished. And so if you're going to ask me, okay, are you going to add to any other position here? Like I said, SoFi, Nebius, I think I can keep on adding dLocal, even an Uber, Rubrik for sure, Oscar Health, and then Netflix and Robinhood. I want to increase those positions as well. Dollar-wise, they will all need, well, dollar-wise, I think Netflix, Hood, Oscar, Rubrik, and Shift4 will all reach around $15,000 to $20,000 or so per position. Talking about the other positions outside the portfolio, which are CoreWeave and Iron. As you can see, I now only own 300 shares of Iron. The average here is still just under $24. I'm still up 74.5%. Yes, I was up more than that, but hey, I'm happy with that exposure here. Having the exposure Iron, CoreWeave, and Nebius, I've always said it, for me, it's Nebius number 1, CoreWeave number 2, Iron number 3. I don't have to be overexposed in that team. CoreWeave, I am still up 2.9%, especially because Friday was an extremely good day. Stock went up by 20.5%. If we go back to $100 or maybe even more, I don't know, a month from now, don't be surprised if I do take some profits here, because again, there is a lot of money in play in those names. And if a Rubrik or a Shift4 and things like that, mostly non-AI related, I would say, although Rubrik with AI agents, you could say it is AI related. If they're still down so much, they're still trading at super attractive prices, or even an Uber or whatever, then yes, maybe I'll add more to those names and take some profits from here. And that's not because I'm bearish AI, it's just because Nebius to me still deserves to be by far the number 1 for my portfolio. You might have Iron number 1, CoreWeave 2, and Nebius 3, that's up to you. But to me, as I said from the start, I believe way more in Nebius. And if I want to have extreme exposure, it's probably going to be through that name. Then, you know me, I share my winners. I will not hide behind the fact that I have here an extreme loser in PayPal calls, right?
You've fallen right into my trap. Activate bag holder.
When I did the transformation in the calls, $65 and $70 for June and January 27 seemed like, okay, this is definitely going to happen because we were quite close to those numbers. But guess what? No, I got absolutely crushed here. Here you have it, a big loss for me personally, especially money-wise.
Where's my f***ing money, motherfucker? Where's my money, bitch?
Why don't I sell it? Well, what's the point, right? What's the point? There's no point in selling this. For the January 2027, the $70 ones, who knows, maybe by a miracle, the new CEO over-delivers for once. It might happen. Now you might say, oh, this is copium, hopium, whatever you want to say. Yeah, maybe. But they still are expecting to generate $6 billion in free cash flow, and they're still expected to buy back $6 billion worth of shares. And so the EPS guidance and all of that, to me, it doesn't make any sense. I think it's extreme sandbagging to make sure that the new CEO has an easy year, and then we'll see. Maybe there will be layoffs and it could, I don't know. We'll see. But to me, I'll hold this back until it expires. Another thing here, if you look at the top 10 visited financial websites in, I believe it was January, or maybe it's a bit strange to have February here, but even if it's the start of February, Yahoo Finance number 1, Robinhood number 2, Polymarket, Coinbase, Bank of America. At number 6, you have PayPal with 24.4 million. Number 7 is Cash App. Number 8 is Venmo with 20.2. And so if you put PayPal and Venmo together, you are essentially here at number 2 in that list. Clearly, they do have some power. As I said in the last video, when I talked about this earnings report, there were some positives, but the big negative was the fact that they were hiding things from us. Right? You do not replace a CEO because something changed last week. You do not suddenly issue such a bad guidance for 2026, unless, of course, you want to make the new CEO look good when he does a beat and raise for the next coming quarters. You do not remove the 2027 targets just like that. They probably knew this 3 months ago or maybe more, yet they didn't do anything. Yeah, maybe there were signs. Maybe the fact that they didn't want to talk to either my channel, Roy, Tanner's, right? They didn't want to schedule anything, didn't want to respond anymore. Maybe that was already one sign. Second of all, no accelerated buybacks, no insider buying. Might have also be a sign. The fact that they have a partnership with Liverpool might also have been a big sign, right? Sorry, I had to do it. Anyways, this is my big loss here, the PayPal options. Moving on to the market stuff. One green day and we already are in neutral territory. It doesn't make any sense. As you know, this is the fear and BS index. This makes no sense. How can one Friday remove us from fear? I was sure we were still in extreme fear, even after Friday. I mean, don't get me wrong, Friday was an amazing day. Made my weekend 10 times better. Although I did spend it with my niece and nephews. I'm tired now, but still, there's no way we are neutral. Then, Friday, before the market opens, we had this. The Nasdaq 100, 31% of the stocks were oversold. 31% of Nasdaq 100 stocks were oversold. The last time this happened was, of course, April 2025. Now, if you look at what happens over the next couple of days and weeks, market should be okay. Then, if we look at the total put to call ratio, it is, again, the highest it's been since the last, pullback we had towards the end of 2025, October, November or so, which indicated some bottoms. So was Friday the bottom? I don't know. I'd love it to be. Some people would like to continue to see the market go down. I think we would be very happy if we start to make our way back up. Although a lot of the stocks, maybe non-popular stocks, are going up. That's the thing. And you will see that in a bit. On Friday, we've also had the VIX go down 18.4%. So what happened with the S&P 500 after the VIX is down at least 18.4%, while the S&P is within 5% of all-time highs? Well, 1 month later, in every example that we have here, 1 month later, 100% of the time, we were green. Now, if we look at the S&P 500 component correlation, it is at the lowest point since 2000. Does this mean that we're going to see a crash soon? No, but it does again show you that there are some weird movements in the market. The market has basically done nothing over the past 3 months or so. Over the past 3 months, we've gone higher, we've gone lower, but that's about it. Despite a lot of the stocks in the market actually finally start to participate in this so-called extended bull market. It might not feel this way because the large tech companies are not participating. Most of the large tech companies, especially the software names, but even the AI names, over the last couple of months, they've not participated anymore. They either remained flat or they went down. And since they weigh quite a lot in the index, if they don't participate, we are not going to go higher and higher despite a large chunk of that index making its way up, which is why we have seen a lot of conflicting data. Every time we looked at these types of data, yes, there were some conflicting signs. Some of these numbers were bullish, some of these numbers were bearish. But like I said, over the past couple of months, we haven't really done much. We've done up and we've gone down, which is why the data is a little bit conflicting because the market doesn't know where it wants to go. Hopefully it does continue to go up. We don't have to go up parabolically. No, slowly but surely, again, good companies getting rewarded, bad companies getting punished is exactly what I want to see. Finishing off here with the sports section, we've had quite a good weekend in the Premier League. So Manchester United continue their win streak, in this case 4 wins in a row. 1 extra win and that dude can finally cut his hair. And in this case they won against Tottenham Hotspurs. I'm not that surprised. Romero, the serial red card guy, got a red card. This guy needs to get banned for, I don't know, 10 games or so. Terrible, terrible guy. Then we've had quite an entertaining second half. Liverpool-Man City, comeback from Man City, which means they're keeping the pressure on Arsenal. Now, the big call here was that it should have been 3-1 for City. But for some strange reason, they cancelled the goal. They went back and gave Dominik Szoboszlai a red card because he pulled Haaland before the ball went into the net. To me, it doesn't make any sense. The ball went into the net. Who gives a crap if Szoboszlai pulled his shirt? The ball went into the net, give the goal, move on. And then we've had Arsenal win 3-0 against Sunderland. Quite a normal and easy game for them. We had Wolves against Chelsea. Hat-trick, Colt Palmer. Magnifique, yes, 2 penalties. Who cares? Bayern München, 5. Hoffenheim, 1. We have here 2 goals from, of course, the one and the only Harry Kane. And 3 goals from Luis Diaz. Bayern back to winning ways. And then for the Americans, I hope you enjoy your Super Bowl. Let's go Chiefs. I know, Chiefs are not in the Super Bowl. I know, okay, calm down. I know it's the Patriots and I know it's the Seahawks. No idea who their quarterbacks are, and to be honest, couldn't care less. There's only one football, and that's this game right here. This is Pigskin Egg Bowl. Lastly, some entertainment recommendations. So, for those with kids, or maybe you are a kid, or maybe you just like these types of movies, Zootopia number 2. Second highest grossing movie of 2025. I think it grossed now $1.8 billion worldwide. Very enjoyable movie. Then TV show. Yes, it is not like Game of Thrones or House of the Dragon, but The Night of the Seven Kingdom is a very enjoyable show. Could have been a movie though, because every episode is around 30 to 35 minutes long. Yes, it is very short, but it is a good TV show. Then, if you are bored, or I don't know, if you like these types of movies, or if you like some other things, The Housemaid with Sydney Sweeney and Amanda Seyfried is an enjoyable movie for a night with popcorn and a drink. And so to end this video, as you know, when there is a lot of red and when there are pullbacks or when stock crashes, then you will see a lot of Peter Lynch videos popping up. So here we are. Hope you all enjoy your weekend still. See you all in the next one. Bye-bye.
And history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. If you understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it, 14 to 22 is terrific, 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be very, people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. So I think that's the key to element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor. You're not sure this Walmart can make it. You want to check. You see them operate in small towns. You're afraid they can only make it in 7 or 8 states. You want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money. But you could have waited 10 years after Walmart went public and made over 30 times your money.